Hi everyone, Billy here from iTradingU. I'm going to show you a practical example today of how do you use options as hedging instruments in your portfolio. Now, what is hedging exactly? It usually takes on one of two forms. The first is the physical mitigation of risk, and the second is trying to alter the potential outcomes of a trade. And one would do that in order to either achieve an enhancement, so in other words, something better than what the market can give you currently, or a potential participation in favorable movements. Now, the example I'm going to use today is assuming a long position in the SPY, and the current market level is 186.97. Over the last 2 weeks or so, there's been more and more articles appearing anticipating a fall in the current market levels. So what would you do if you are long the shares? The one thing you can do is just sell your shares outright. So in other words, exit your position at 186.97, and now you're on the sidelines. Now you can afford to just sit back and see what happens to the market. The second alternative that's available is to buy some time. So in other words, let's give the market some breathing room, see what unfolds, and then decide with all this new information, decide what we want to do with our underlying position. I do want to make mention of the fact that the strategy that I'm going to use is assuming some general market knowledge around trading with options. So if you're a beginner, I would suggest just have a look, see what can be done with options, and don't be too worried if it doesn't make sense yet. I mean, that's what we run our option courses for, and as you spend some time with us, all this will become much more comfortable for you. But for now, just understand the dynamics of what's happening. The strategy I'll be using today is a multi-leg strategy. I'm actually going to do more than one option at the same time to create this payoff profile. I'm not going to spend a lot of time on the construction of the trade because I want to show you the outcomes more so for now. But just for those of you who have interest in it, the trade contains the following three options. I've sold a June 187 call, at the same time bought a June 190 put. In addition to all of those two, I've also sold a 183 put for June. Net, this strategy costs me a premium layout of $48. Now let's look at the potential outcomes of this strategy. And I'm going to compare it to our original trade, which was just to exit at 187 or current market spots. Now if you look at it, if I was to just exit the trade, that will be the purple line. So in other words, it's a single event saying at 187 where the current spot is, I exit my position and my level that I achieve on my trade is 187. But what I have done is I've actually created a bit of a range. Instead of being reliant on 187, I say anywhere between 180 and 190, my strategy is not only matching the previous strategy, but outperforming the previous strategy. Let's use 185 as an example. At 185, if you compare strategy 1, where you just sold your shares, you would have earned 187. You can see at 185, I am earning 190. So that is an example of how options can enhance a position over and above what the market can give you. Now let's look at the risks. On the way up, I would say that this strategy is very similar to the one of just having sold at 187, because you can see the blue and the purple line on the way up isn't really too far apart. On the way down, though, there's something we have to consider. Below 180, the strategy that we have done originally, just selling our shares, would have still just yielded 187, which is that purple line. But you can see the blue line drops off into a negative position. But now I would take the following into consideration. Remember, this is a 1 month trade. And what we're trying to do is we're trying to evaluate the market within this period of time. It doesn't mean we have to wait until 1 month is finished before we act. So on the way there, we have more information coming our way, and we can make a dynamic decision at that point to exit the position or change or alter in any way we want to. But let's just assume, for the purposes of this example, we held the position right up until maturity. I still feel comfortable with it because currently we're at 187. We are fairly safe right up until 180. Even in the case where the market goes against us and the spot stops at 174, our effective rate is still 180. So we've created this whole square in which our position looks far better than the market does. And even if the market goes against us, our effective rate is still far better than what the market would pay us. So to me, again, just an example of how useful options can be in your portfolio. And I'm not just talking about the leverage effect of buying options on stocks. This is an example of how you can use options to dynamically change the payoff profile of a trade. I really hope you enjoyed this session. There will be tons more with regards to how to use options correctly. And I do invite you to come and join us at one of our upcoming options events. This is Billy from iTradingU, and I hope to speak to you soon.